All right, let's dive right into this explainer and unpack a truly massive corporate shakeup. So after 140 years of building, well, pretty much everything from your living room thermostat to complex cockpit systems, a massive conglomerate has actually split. And the result? The birth of Honeywell Aerospace. We're talking about a $78 billion pure-play aviation giant. It is easily one of the biggest market moves we've seen in the industrial sector this year, and man, we have a lot to unpack.
To make sense of all this, we're going to break it down into 5 quick parts. First, the aerospace spinoff. Second, the financial foundation. Third, the bull case. Fourth, the base and bear cases. And finally, key metrics to watch.
So, Part 1, the aerospace spinoff, separation from the conglomerate.
Look at how fast this all moved. The rapid succession of events leading up to the split really tells a story of intense, deliberate preparation. Back in March 2026, they executed a massive $16 billion debt offering. Then, they followed that right up with a blockbuster Q1 earnings report revealing some incredibly deep backlogs. So, by the time the official spinoff actually happened on June 29th, this aerospace unit had already proven to the entire market that it was more than ready to stand on its own 2 feet.
That $16 billion figure from March, that was literally the linchpin of the whole operation. It was strategically split between new money notes and exchange notes, which gave the new aerospace entity a fully funded balance sheet from day one. But what's fascinating is that, at the exact same time, it allowed a massive cash distribution back to the parent company, Honeywell International. Essentially, the spun-off unit paid the parent company to help clean up their legacy leverage.
Moving right along to Part 2, the financial foundation, starting from a position of strength. Now here's where things get really interesting. $38 billion. That is the staggering company-wide backlog Honeywell Aerospace launched with. Honestly, if you've flown anywhere recently, you definitely relied on their tech. This massive backlog is heavily driven by record orders coming in from both Airbus and Boeing. Honeywell is sitting right at the absolute center of the 2 most important commercial aircraft production ramps in the world right now. That $38 billion isn't just a number, it's a massive safety net. Just before the split, the parent company's final Q1 earnings give us a sneak peek into the engine room. Total sales hit $9.14 billion, with 2% organic growth. But let's be real, the absolute star of the show was the bottom line, a 23.3% segment profit margin. Before the spinoff, the aerospace division was consistently the primary growth engine, literally dragging the rest of the conglomerate forward. And this margin, it absolutely proves why. And management is definitely not playing it safe with their future outlook. They've set some highly aggressive targets for 2030. They're projecting 6 to 8% organic annual sales growth, high single-digit international defense growth, and generating north of $4 billion in free cash flow. Now, a quick reality check here. The CFO did specifically warn the market that this earnings progression won't just be a perfectly straight line up, especially since they plan to invest heavily between 2026 and 2028.
All right, Part 3, the bull case, ready for takeoff.
So why is Wall Street getting so hyped? Well, listen to Jim Cramer. He paints a highly optimistic picture for the bulls. Pointing to the recent massive runs we've seen in Boeing and GE, he argues that among its pure-play aerospace peers, Honeywell actually offers the most raw upside potential right now. To the bulls, any recent pullback in the stock is basically just a temporary post-spinoff dip that's creating a prime buying opportunity.
The whole bullish argument really boils down to shedding baggage. For years, the aerospace division was weighed down by a conglomerate discount. Its valuation was blended and, frankly, heavily diluted within a parent company juggling all sorts of disparate missions. The bulls firmly believe that by breaking those chains, the new company will finally shed that discount and earn a premium, pure-play multiple that actually rewards its focused defense and aviation growth.
And you can see this optimism backed up by the numbers. Consensus estimates from Ticker project a very steady climb in free cash flow. We're looking at a jump from $4.3 billion in 2023 straight up to $6.1 billion by 2027. The bull case assumes that as supply chain inventory finally normalizes and the management team zeroes in on one singular aerospace strategy, this cash generation is just going to rapidly accelerate.
But, we have to look at the other side of the coin. Part 4, the base and bear cases, the cautious perspective.
Morgan Stanley came out right after the spinoff and basically said, let's tap the brakes a bit. They initiated coverage with a neutral equal weight rating and a $255 price target.
Now, they aren't saying it's a bad company. They fully agree it's a very high-quality business with industry-leading margins, but they believe it's already trading at a fair, fully priced valuation, meaning it might have limited immediate growth potential compared to its pure-play peers.
They laid out a pretty wild spread of possibilities. Morgan Stanley's $355 bull case requires a total perfect storm, roughly 10% revenue growth and near 100% free cash flow conversion. But look at that $175 bear case. That exposes some immense downside risk if revenue growth slows to 5% and those pesky supply chain bottlenecks bite back. Their base case kind of assumes a cautious middle ground, with margins simply staying flat.
To really get why Morgan Stanley is hesitating, we need to talk about the commercial aftermarket. Think of this as the highly lucrative parts and repair business. It generates massive, predictable revenue for literally decades after an original aircraft is sold. Make no mistake, this is the absolute lifeblood of Honeywell's long-term profit engine.
And this isn't just a side hustle. It's a massive 44% of Honeywell's total sales. This right here is exactly what Morgan Stanley is worried about. They pointed out that recent historical declines in original equipment market share could act like a ticking clock. Eventually, that could shrink this vital, high-margin aftermarket revenue stream in the decades to come.
There's also this fascinating tug-of-war over who actually owns the stock right now. The bulls claim the stock is an undiscovered institutional story, just primed for a massive price jump once the holdout sellers from the old conglomerate finally clear out. Bears, however, are pointing to a much harsher reality. Immediate S&P 500 inclusion on day one meant massive index funds were automatically forced to buy it. So, to the bears, it's not undiscovered at all. Everyone who needs to own it already does.
Which brings us to our final section. Part 5, Key Metrics to Watch, Navigating the Future.
So how do we figure out who's right? As we look out to 2027 and 2028, these are your absolute vital signs. Are they winning next-generation aircraft content to feed that massive future aftermarket pipeline? Are they actually hitting that near 100% free cash flow conversion rate? Ultimately, the ability to successfully resolve complex contract negotiations and finally ease those supply chain bottlenecks will dictate if they can expand those industry-leading margins.
So here's the multi-billion-dollar question we're left with. Will this new pure-play focus ignite a historic era of growth and a true premium valuation, or will the cautious bears be proven right by a market that's already fully priced in the upside while aftermarket risks loom in the background? It is a massive story unfolding right before our eyes, and the data over the next few quarters is going to be the ultimate judge. Thanks so much for joining me on this explainer of the Honeywell Aerospace spinoff.